Hi there, everyone, and welcome to this edition of On Track. So it's 29th of April as I record this. We're about to go into another long weekend. It seems in Queensland we have about 4 long weekends in a close period of time and then nothing for a while. So we're going to have the numbers to the end of March. It's been a fascinating month. Before I get started, just the usual disclaimer. This video is designed for clients of McGregor Wealth Management, particularly those that use the care investment process. Anyone else welcome to watch it, but please get advice that's suitable to your own circumstances. Today, I'm going to have a look at some of the economic news. We've had budgets out and things like that. We're going to have a look at inflation and interest rates and defensive investments. A hot topic at the moment as inflation numbers go up and people worried that they're going to stay up and it's going to push interest rates up. So we'll dive into that. I'm going to have a look at the magic of compounding. It's easy to get caught up in current returns and forget about what good returns do over a long period of time. So we're going to show you what happens there. I'm going to talk about some of the headwinds and tailwinds in the property market. And as always, try and put everything in perspective around your investments. The news highlights. Have a look at the table on the right. The RBA still hasn't put up the cash rate yet, but it's likely it will go rapidly up after the election. They tend not to mess with the cash rate during election. They never want to be accused of political bias, but the markets have already factored in. We see, so the cash rate of 0.1%, we see the 90-day bank bill rate, so that's the 3-month rate, has jumped from 0.17 to 0.54, and the 10-year government bond yield continues to rise and is settled at around 3.1%, starting to get back to what we'd call more normal or pre-COVID levels. Aussie dollar had a big move up to about 76 cents, came back to about 71 cents. That affects the value of your international shares. It also affects the value of things you're importing. As the dollar drops, it makes international goods more expensive. Inflation in Australia has bumped up from 3.5 to 5.1%. And in the US, it's bumped up from 7.5 to 8.5%. And this is where people are starting to get worried about what does that mean for interest rates. And I'm going to dive deeper into that in a few minutes. Mortgage rates in Australia still haven't moved much at the variable level. The lowest is about 1.85. I'll show you where they're charting towards the end of this presentation. Macquarie's variable mortgage rate, 2.14%, and there's still plenty of twos in mortgage rates, although fixed rates have moved up, and I'll talk through those shortly. And look at this, we can now get 2.1% on a term deposit after it being as low as 0.3% for most of the COVID period. We're now getting back to some decent returns. And it's interesting, when we've had ultra low, all of a sudden 2.1% feels all right, although it didn't feel that good when we were there last time because we were used to 3s and 4s, etc. The Ukraine war grinding on. The IMF has downgraded world growth to about 3.6. I'd point out that that's still good growth. The chart here down the bottom shows that back from the 2020 drop in world growth. We can see some good economic indicators, particularly coming out of Australia, and Europe's on the march finally after being down during COVID. And that's resulting in good economic numbers for Australia. I'll talk some more about some of those numbers that came out of the budget. And look, global COVID cases are falling. I think most of the world stopped sort of worrying about it as much, except for China, that is still locking down, which is part of the reason for that lower growth forecast from the IMF, along with the Ukraine war grinding on. Most of the world is just starting to get on with it, and restrictions are dropping. And I suspect the numbers are probably not that accurate, as many people now do their testing and don't necessarily report it into the main numbers. Either way, it's a good thing that we're getting back to normal. So let's have a look at the care portfolio returns. And it's interesting, 1-month numbers are back in the positive, but 6-month numbers still pretty flat. 3-month numbers are negative. Most of that's been driven by negative returns on international shares and negative returns on fixed income. You can see international equities to the 3 months ending in March. And at this stage, the Aussie dollar was up around 75, 76. It's come back to 72, but the negative returns show up in all things international over 3 months. Long-term, 1 year, 3 year, 5 year returns still looking right on right on our budgets, actually, with good returns showing up. And I'll dive into these in a bit more. We see the market with the correction we've had in the last few days at fair value. That means it's a safe time to be investing and a safe time to be staying in the market. We expect more volatility, and I'll talk you through some of the ups and downs we've seen. I just want to re-point out, I may have done this one before, but I've never seen so much recency bias. And recency bias is just where we focus on information that's present right now, and we tend to overweight that information when considering how important it is. So right now, things like the war, it comes into play more. We've seen this with COVID. We're seeing it with inflation. And I'm going to go back and look at inflation and interest rate numbers with a much longer term perspective, rather than just the hype that you get out of the media, which is recency bias on steroids. It's all about inflation, as I said. And the top two charts here, the top left is Australia. You can see it coming out of this long-term down run. And we see from 1974, where inflation got up to about 17%, we've had literally 42 years or 41 years of interest rates coming down, inflation coming down, and now inflation going up for the first time in a few years. The US is the same, but the numbers are bigger. It's bumped up to now about 8, Australia about 5. But the big question is, what does it mean for interest rates? What will it mean for interest rates, particularly mortgage rates, but also other rates as well? And that's a much harder one to tell. The media and a lot of analysts that are focused on the short term want to make out like it's going to be like 1974. And you can see in the 1970s, inflation went through the roof, mainly off the back of the Middle East crisis, Suez Canal blockade, oil prices going through the roof, and we hit a period of stagflation. Everyone's worried about, not everyone, but the media and short-term focused people are worried about that, because look what happened in the 70s. We've got long-term government bond yields down the bottom here, and they went from 3-4% all the way up to 14% in both Australia and the US, and then slowly back down again. This data only goes to 2010, but obviously it kept going down. It's extremely hard to get long-term rates. The Reserve Bank of Australia only came into play in 1959, so it's hard to get good numbers. But I wanted to compare, because there's a tendency to say, wow, look what happened in the 1970s. That's going to happen again, surely. But if we look back in Australia to the late 1950s, we had inflation even higher at 20 to 25%. And it was the same in the US. Now, it's harder to remember what caused that, but it was actually caused by the Korean War and the post-World War II recovery that pushed prices up. But if we have a look at interest rates down the bottom here, it didn't push interest rates up much. Interest rates stayed in that sort of 3 to 5% range. They would eventually go up as inflation fell for completely different reasons. So we're just unpacking here that rising inflation doesn't always lead to sustained long-term interest rates. It might not. The difference will be whether it gets caught up in the wage increases. In the 70s, both Australia and the US had a lot more people in unions. It was over 20%. It's single digits these days. And wage prices were linked to inflation in many cases. So if you've got a 10% inflation number, that led to 10% wages. That caused people to put up prices by 10%, which led to 10% inflation, which led to 10% wage rise again. And it got locked in. That will be the worry if it gets locked in here. It doesn't look like it's going to, but it's too early to tell. Our view at the moment is interest rates are coming back to pre-COVID levels. What happens from here is extremely complicated, and it depends how we come out of this in terms of the world economy. Higher inflation does not necessarily mean we'll be at extremely high mortgage rates. It's fairly probable that inflation will fall as we come out of the temporary stage that COVID's led, particularly supply chain issues. For any of you that have ordered new cars, caravans, boats, that type of thing, or who are building a house, you'll know, one, prices have gone up. Two, it takes a while to get stuff. So that's what's causing these price increases to some degree. Some of that will be temporary. Some of it will work its way out over the next year or so. It's hard to tell exactly how quickly. but we don't think we need to be overly concerned about interest rates going through the roof and following up those inflation numbers. But you can't tell for sure. The bond market, which is the smartest money in the world, so this is where government bonds are traded. This is the yield curve. I showed this to you last month, and it shows the interest rate. So the blue line is right now, 28th of April, interest rates on bonds, government bonds of different maturities. So the 10-year bond, currently about 3.1%, gone up in the last 6 months from under 2%. And you'll see it's gone up in the last month by about 0.3%. But look how flat it is. At 30 years, it's still low 3%, similar to 10 years. So this is the bond market telling us it doesn't think inflation is going to go up. If the bond market thought inflation was going to be here for a long time, was going to go up steadily and stay up, longer term bonds would be much higher rates. We see exactly the same in the States, where we're at about just under 3% from anywhere from 4 years out all the way up to 30 years. That's telling us the bond market does not think inflation here is sustainable. Now, the bond market may be right, it may be wrong, but it's the best informed opinion in terms of understanding what the market professionals think, not what the journalists think or not what the media thinks. Now, this is important because when long-term rates rise, bond returns can be negative. So I've put in this chart, which comes from Morningstar, which shows long-term asset class returns to the end of March. And I've highlighted there the two fixed income columns. And you can see here fixed income has had a negative return over the last year, but particularly the last 6 months. And that's because long-term bonds have jumped up to 3%. Every time there's a 1% increase in long-term bond rates, it results in about an 8% fall in long-term bonds. Now, this is really important, and this is why we don't have much in the way of long-term bonds in the portfolio. It's been a deliberate position of ours for the last few years because we've been concerned that as interest rates start to march back up, this type of thing happens. We haven't experienced this since 1994. So for a lot of fixed income investors, this can come as a surprise because their defensive assets actually return worse than potentially the share market. So in the last year, Australian shares have gone up 9%, international shares 11%, but bonds across Australia and globally are down 5%. So they haven't done their job as defensive investments. In our portfolios, we actually have almost no long-term bonds. That's resulted in us being up the top of the ladder in our balanced and moderate funds in the top quartile. This is a chart that we benchmark ourselves to other funds in the Lonsec performance survey, and this shows for multi-asset 41 to 60%. So that's kind of moderate to balanced. And you can see our core balanced fund sits comfortably right up near the top, our moderate just in the top quartile. But if you look at the 6 month returns here, you'll see, while we sit, in the top bit there, our friends at, say, Vanguard are right down the bottom at 47. And the difference over the last year is about 2%. Now, Vanguard is 100% index, a great company. We use their funds in the share market, but on the bond side of things, where we use them much less because their bond portfolio has this long-term duration. And this can be complicated, but as interest rates rise, we don't think it's worth the risk of holding long-dated bonds. We much prefer the short-dated bonds, and that's why we don't use index there. And that's one of the reasons that our funds continue to do well compared to both active managers, but also compared to index managers. So let's talk through some of the market context before we go in. We still think we're absolutely in the wall of worry at the fair stage. There's lots of people worried about lots of things. Ironically, we don't think you need to be worried about those things, particularly when you do the things that we suggest, which is having enough reserves in the portfolio, a conservative position, and dollar cost averaging for our younger clients. As I said, fair value. That means we don't think there's a high probability of a drop of more than 20%. We know we can never predict 10% drops, and I'll talk you through those in a minute. They occur almost every year. They've certainly occurred this year. Impossible to predict, but the 20% drops are a little bit more, not easy to predict, but easy to tell when we're in the zone where it's possible. And that's when we hit that FOMO sort of stage. And we haven't been there for the last 10 years. We haven't been there since 2007. I wanted to pull some slides out of the federal budget, which was released last month. And I wanted to look at COVID's impact on the Australian economy. And the pretty good response we had from the government. It's easy to get caught up in the election here and the media bagging, how badly Australia did, but Australia's probably had the best result out of COVID. This first chart shows our deaths per 1,000 people, and Australian death rates during COVID only got as high as 0.2 per 1,000, whereas the OECD, that's the advanced countries of the world, was 10 times higher than that. So we were 10 times better in terms of preventing deaths. In terms of the economy, Australia is one of the best in the OECD. You can see that our GDP, which is the amount we produce as a country, is 3.4% higher now than it was before COVID. The US is 3.2% higher, and lots of Europe and other developed countries are still lower than they were pre-pandemic. So that's a good rate, and up there with the US, but the US had much higher death rates. It was actually above that OECD average. So yeah, we got the twin peaks right of good economic recovery and minimal deaths. So a tick of confidence to the authorities. And that's both state and federal. There's also a bit of the lucky country in that. We're an island, it's easy to shut people out. But yeah, we still had to, and the reason the economy did well is because we spent money. In the budget papers here, this shows our deficit, and think about a budget deficit in the cash balances. Is it like if you earned 100,000 and you spent 110, you would have a deficit of $10,000. So the government's running a deficit at the moment. So they're spending more than they're making. And in 2021, that was about 134 billion. It's dropped to about 78 billion. Billions sound like a lot of numbers, but if you divide that by the Australian population, you get some levels. So it's actually only about 3,000 per man, woman, and child in Australia each. We've accumulated $1 million of debt. Sorry, $1 trillion of debt. And $1 trillion sounds like a lot, but $1 trillion is only about 38,000 each. Net of the government's assets, we have net debt of $750 billion, which is about 27,000 each. So that's the price we've paid for the government to save the economy during that period. It's not a bad price. The worry will be, how do they get that down? And until we start to run surpluses, that's not going to come down anytime soon. Now, a lot of that debt was raised over the last couple of years. So government bonds were only paying 1%. So the government doesn't have a very high interest rate to pay on that debt at this stage, but in 10 years' time when those bond rates roll over. So yeah, we don't have a great amount of debt. It's actually better than we thought. Last year, when the government did its mid-year economic forecast, GDP was set, so government debt was set to jump to 50% of GDP. But because our economy's recovered quicker than they anticipated, it's likely to settle at about 45% and drop back down to 40%. So that 10% is substantial, and it's better than we thought, and it's certainly better than other countries. Australia's government debt as a percentage of GDP, as I said, about 45%, but you've got countries like Japan at 250%, Italy at 150, and even the US at 120. So in a much better position than most of the world, which is a good thing. You'll hear people dramatise the debt we've got, and while the debt's not great, it's not as bad as it could have been, and not as bad as many others. And talk about how most investors mess it up, and we see that even with professional investments. And it's been a crazy 3 years for people that have been reacting to the market. There's been lots to react to, lots of short-term focus, lots of single issue obsessions. Media has had people glued to the TV on so many things. There's the COVID, as COVID diminishes, the daily press conferences, all that stuff go. The media is looking for new ways to keep you glued. The war is certainly providing for that. The election's providing for that at the moment. We're seeing crazy stuff where they're out trying to gotcha or get politicians to say silly stuff so they've got a headline. We saw the elbow quiz where he didn't know the unemployment rate and the RBA cash rate, which is a bit of a drop the ball for him. But it's certainly not, well, it's a drop the ball, but the media is deliberately trying to set up politicians. So they've got these moments on the snapshot. It means we don't do any debate on the substance of what either party's got, although neither of them are promising much at all. They're both trying to sneak in the coalition on their track record, the devil you know, and the opposition on the fact that Morrison's unpopular, despite holding us through COVID, etc. It's going to be a toss-up. The odds are on a hung parliament at the moment, but there's a long way to go as I speak. And I suspect we'll have a hung parliament with some minority government. Could go either way. It looks like a Labor minority government at this stage. Both parties have said they won't form a minority government, but I wouldn't necessarily believe that. I'm not going to go through the 4 pillars of the core today, but you're going to hear me talk a lot about history. You've already seen me talk about that with the inflation. It's a critical part of holding your head, not doing crazy behavioural mess-ups, like we say, when there's a lot of stuff going on. So understanding what's happened before in times like this is critical, and we spend a lot of time there so we can run the portfolios and continue to get good returns. I'll dive through the asset allocation, each of the asset class returns here. And as I do it, I'm going to look at the beautiful effect of compounding. So in the last month, Aussie shares were up really well in March, mainly because commodity prices were high. And that was partly because of a lot of the stuff that Ukraine and Russia export. Think oil, think wheat, think iron ore we make. So we were getting higher prices for that. So that was good for the Australian share market. Long-term 10-year returns on Aussie shares is 10%. That's resulted, when you look at this table down the bottom right-hand corner, $10,000 invested 10 years ago is worth about $25,000. Not pretty good for a 10% return. 10% return will double your investment about every 7 years. So over 10 years, a double and a bit. So yeah, beautiful compounding. But it's interesting because international shares, and if we have a look at US shares here, US shares went pretty square for the month, slightly negative. Long term, sitting at 17%. So that's much more, 17% for the last 10 years. That's partially because of the Aussie dollar falling from about $1 to 70 cents during there. So that gives a free kick to international shares during that period of 30%. It can, of course, swing the other way. So US shares, 10,000 invested in US shares as an Aussie back in 2012 is now worth 52,000. So up 5 times, quite spectacular. So that extra return of about 8% has resulted in an extra 27,000 on each $10,000. Now, it won't always do that. And for the next 10 years, it might be the other way around. And that's why diversification is so critical. And that's why we rebalance the portfolios regularly. Same story for US small caps, not quite as much. The 10-year return there, about 16.1%. We're negative for the month. But over the last 10 years, your investments in US small caps have compounded every 10,000 to 44,000. So once again, beautiful compounding, delivering spectacular results. Global leaders also benefited from that good growth, around 15% over 10 years, which has resulted in 10,000 growing to 42,000. So wonderful returns. Once again, I'll repeat, part of that is due to the Aussie dollar falling over that 10 years, which probably results in that being about 30% higher than if the Aussie dollar was still at $1. Now, obviously, if the dollar goes back up from 70%, that may put a handbrake on those returns. And that may or may not happen. You can't see it at the moment. The Aussie dollar normally climbs up back towards $1 when there's a commodities boom on. And while we've had good commodity prices, Treasury, the Australian Treasury and others forecast those to be declining as the world gets back out of these supply chain issues. So it doesn't look like we're at the start of a commodities boom, which means you would think the dollar will stay reasonably stable. We look at emerging markets, and they're the opposite end. Emerging markets have been troubled. In the last year, they're down 12%. And emerging markets, think China, think Russia. China's had an increase in its sovereign risk. That's the risk that the government does things that share markets don't like, and there's been plenty of that. Russia's obviously had the war, all the sanctions. So those two bits have been very negative on emerging markets. Now, emerging markets are one of those sectors like global small companies that we know will have above average returns in the long run, but they may be more volatile in the short run. That makes them a perfect part of a portfolio in small amounts because we can rebalance and over the long run achieve really good returns. In the last 10 years, emerging markets has only had a 5.83% return. So $10,000 has only grown to $17,600. Now, I say only because that's still not a bad return when cash rates have been close to zero, and $10,000 left in the bank would hardly have grown at all. So even the worst performing growth asset here has still done particularly well. Gold, its 10-year return is about 4.5%, so it's also grown to about 16,000. But gold's our hedge, our insurance. Gold goes up when other things go down. You'll see its 3-year return. So through COVID, through the war, has been about 16%. So it's the highest 3-year return. But once again, this points out the importance of rebalancing and the importance of diversification. Let's jump to property prices. And I love this slide to show just the nature of property cycles. Property doesn't go up a straight line like the dark orange line there. It actually goes up in that more like that S shape. That can be varied depending on exactly where and when. But we can have long periods of nothing followed by rapid growth, followed by long periods of nothing, and sometimes even drops. It's interesting to look at some of the headwinds and tailwinds. A definite headwind for property prices in the next little while is rising interest rates. The top chart here shows the rise in fixed rates. So the dark blue line at the top is the 5-year rate, the red line is the 4-year rate, the orange the 3-year. They're now back to pre-COVID levels. And don't forget, we all thought they were spectacularly low pre-COVID, but they got lower. Some of us, including myself, lucky enough to lock in 5-year rates at closer to 2% when it was there, or in the high 2s. That's looking good at the moment. Variable rates, interestingly, when you look at the bottom chart, haven't moved. They came down, and at the bottom of that bottom chart is the RBA cash rate, nothing but down to its current level of 0.1 during COVID. Variable mortgage rates haven't changed yet, but all the media noise is about when they will change. Now, you've got to be careful on this. Fixed rates show where variable rates will head to in the next few years. The cash rate is only one factor that affects mortgage rates. The cash rate will absolutely end up back somewhere around pre-COVID levels. Exactly how close to that, whether it's higher or lower, will depend on how strong the economy is and how much inflation stays in there. There's no one who can accurately predict that at the moment. Our simple belief is that we think interest rates get back to pre-COVID levels, and from there, it will depend on whether there's a strong economy, which might mean interest rates go a bit higher, but that's a good news, bad news story. High growth is good news for investors generally. High inflation can also be good news for investors. The 70s and 80s, when we had high inflation, were some of the best times to be property investors. So watch this space. I expect that variable rates will sneak up over the next year back into the 3s. They'll follow those fixed rates back up. Still incredibly low compared to long-term, but very high for someone who's borrowed at 2%, right up to their capacity if rates go up. Now, the banks assess people at 2% above the rate, so a 2% increase shouldn't push people into affordability difficulties. And Australians have a great track record of paying their mortgages. We very rarely have large mortgage defaults, but that's obviously one of the minor concerns, but not something we think is a likely big concern. Net migration is so interest rates, one of the headwinds on property. Net migration is one of the tailwinds. Australia had no net migration for the last few years. And this article from the Australian Financial Review at the end of March shows that we're actually going to get back to our normal. So, and that's from returning foreign students and skilled immigrants, is going to push us up more likely to the 200,000 that we had pre-COVID. So that's going to counterbalance some of that interest rate increase, because that's going to be 200,000 people every year that are looking for a property. and you can see out there we're already short of rentals. So that's going to balance out the interest rates, and will probably lead to us not dropping as much as forecasters think, although I still think a drop of up to 10%, particularly in the markets that have run hot, is quite possible. Doesn't mean it's going to happen. If property remains as short, particularly on rentals as it is, that's going to keep a floor under that. But yeah, we can expect a plateau and possibly a downturn. The downturns are only ever temporary, of course, and if we keep growing the way I went through last month, with heading up towards 50 million people eventually from our 28 at the moment, we'll certainly see a continuation of property as a good investment, but going through the cycles as we expect. Capital cities, this chart from CoreLogic shows the slowdown in growth. Particularly the chart on the left shows Sydney and Melbourne have stopped growing. So they're neutral, they're not falling as such, but they've stopped growing. Brisbane and Adelaide here still grew in the last quarter by about 6%. So we still see some value for investors in those cities that hadn't gone. You can see they hadn't gone as hard. And you'll see that in the next slide as well. And this slide shows some of the higher growth areas like Hobart and the ACT coming down as well, and Perth and Darwin starting to actually get some growth as well. That's partly because those smaller capital cities, Adelaide, Brisbane, Perth, Darwin, hadn't grown by as much as Sydney, Melbourne, and the freak of Hobart. Waiting for the next month's update of these numbers. This is still the same as last month, but this chart shows the difference between, say, Sydney, which has grown by over 200% since 2012, and Darwin, which is below, well, about the same as where it was in 2012. So hence the need to be very careful when you're making your property investments. The Harrington White property clock, a few changes there. The ones in orange, it actually shows quite interesting. The Southern Highlands, which is southwest of Sydney, has started to decline. That market had run extremely hot. So even in a decline, it's still way above where it was. But this is the first region to start to show some declines. Some of the other areas are approaching the peak of the market: Sydney, Gold Coast, Ballina, Lismore, Coffs Harbour. Some of that, no doubt, not helped by the recent floods. But most of Australia is still rising, but as those last slides showed, at a lower rate. That's it for today. I'm just going to reinforce our process as always, but beautiful, boring diversification with a good asset allocation, plenty of reserves for our retired clients, and dollar cost averaging for our younger clients means that we will continue to be able to plan for you to hit your goals. And as always, avoiding those three ways that people lose money on the share market: panicking and selling when the market's down, having to sell when the market's down, and not properly diversified. I thank you as always for your attention. Let me know if you've got any hot topics you want me to talk about in these forums. And until next time, have a great month. Rob McGregor signing out.